Let's talk about the balance sheet. The objective of this section is to read and interpret a balance sheet. Financial data are transformed into financial information and reported on three very important financial statements: the balance sheet, the income statement, and the statement of cash flows. The accounting equation shows the relationship between the firm's assets, liabilities, and owner's equity. Assets are the resources a business owns, including cash, inventory, equipment, and real estate. Liabilities are the firm's debts and what it owes to others. Owner's equity is the difference between total assets and total liabilities, or what would be left for the owners if the firm's assets were sold and the money used to pay off its liabilities. The relationship between assets, liabilities, and owner's equity is shown by the accounting equation. Assets equals liabilities plus owner's equity. This is the basis for the accounting process. To use this equation, a firm's accountants must record raw data, the firm's day-to-day financial transactions, using the double entry bookkeeping system, a system in which each financial transaction is recorded as two separate accounting entries to maintain the balance shown in the accounting equation. At the end of a specific accounting period, the financial transactions are summarized in the firm's financial statements, and information is presented in a standardized format to make the statements as accessible as possible to the various people who may be using them. A firm's financial statements are prepared at least once a year and included in the firm's annual report, a report distributed to stockholders and other interested parties that describes a firm's operating activities and its financial condition. Most firms also have financial statements prepared semi-annually, quarterly, or monthly. A balance sheet, sometimes referred to as a statement of financial position, is a summary of the dollar amounts of a firm's assets, liabilities, and owner's equity accounts at the end of a specified accounting period. The balance sheet must demonstrate that assets are equal to liabilities plus owner's equity, and the accounting equation is still in balance. Most people think of a balance sheet as a statement that reports the financial condition of a business firm, but balance sheets apply to individuals too. Figure 15.5 shows Marty Campbell's current personal balance sheet. Figure 15.6 shows the balance sheet for Northeast Art Supply, Inc. On a balance sheet, assets are listed in order from the most liquid to the least liquid. The liquidity of an asset is the ease with which it can be converted into cash. Current assets are assets that can be converted quickly into cash, or that will be used in 1 year or less. Because cash is the most liquid asset, it is listed first. Next are marketable securities, stocks, bonds, and other investments that can easily be converted into cash in a matter of days. Next are the firm's receivables. Its accounts receivable, which result from allowing customers to make credit purchases, are generally paid within 30 to 60 days. However, the firm expects that some of these debts will not be collected. Thus, it has reduced its accounts receivable by a 5% allowance for doubtful accounts. The firm's notes receivable are receivables for which customers have signed promissory notes. They are generally repaid over a longer period of time than accounts receivable. Merchandise inventory represents the value of goods on hand for sale to customers. Prepaid expenses are assets that have been paid for in advance but have not yet been used. As shown in Figure 15.6 for Northeast Art, current assets total $182,000. Fixed assets are assets that will be held or used for a period of longer than 1 year. Fixed assets generally include land, buildings, and equipment. Note that the values of Northeast's delivery equipment and furniture and store equipment are decreased by their accumulated depreciation. Depreciation is the process of apportioning the cost of a fixed asset over its usual life. The depreciation amount allotted to each year is an expense for that year, and the value of the asset must be reduced by the amount of depreciation expense. For Northeast Art, fixed assets total $137,000. Intangible assets do not exist physically, but have a value based on rights or privileges they confer on a firm. Intangible assets include patents, copyrights, trademarks, franchises, and goodwill. Intangible assets are long-term assets. They are of value to the firm for a number of years. For Northeast Art, intangible assets total $21,000. As calculated in Figure 15.6, total assets are $340,000. The firm's liabilities are separated into two categories, current and long-term liabilities. A firm's current liabilities are debts that will be repaid in 1 year or less. Accounts payable are short-term obligations that arise as a result of making credit purchases. Notes payable are obligations that have been secured with promissory notes. Only those that must be paid within the year are listed under current liabilities. Northeast Art also lists salaries payable and taxes payable as current liabilities. These are both expenses that have been incurred during the current accounting period but will be paid in the next accounting period. For Northeast Art, current liabilities total $70,000. Long-term liabilities are debts that need not be repaid for at least 1 year. Northeast lists only one long-term liability, a $40,000 mortgage payable for store equipment. As you can see in Figure 15.6, Northeast's current and long-term liabilities total $110,000. For a sole proprietorship or partnership, the owner's equity is the difference between assets and liabilities. For a corporation, the owner's equity, usually referred to as stockholders' equity, is the total value of stock plus retained earnings that have accumulated to date. Retained earnings are the portion of a business's profits not distributed to stockholders. The original investment by the owners of Northeast Art Supply was $150,000. In addition, $80,000 of Northeast's earnings have been reinvested in the business since it was founded. Thus, owner's equity totals $230,000. As the two grand totals in Figure 15.6 show, Northeast's assets and the sum of its liabilities and owner's equity are equal at $340,000.